Hello and welcome to Market Matters presented by Max. I'm Joe Teague of Equity Armor Investments. With me, as always, is Brian Stutland. Say hi, Brian.
Hey, Joe. How you doing this afternoon? New week, fresh start ahead of us. Full trading week, so ready to get after it, right?
Yeah, and you're coming at us from the great city of Ann Arbor, Michigan.
I am. I'm actually stuck here at the Graduate Hotel in Ann Arbor, fresh off a big victory. Went to the game on Saturday, Michigan, Ohio State. So sorry about that, Buckeye fans, but us Michigan people are loving life right now. Behind me, actually, if it looked out the window, tons of snow. Flights are delayed, so I was supposed to be back by now, but obviously that's inhibited me. But thank you to Bill, the manager at the Graduate, who's actually going to be the new head coach of the Detroit Shock, Joe.
Wow,
WNBA is restarting here in Detroit.
is that
So
Bill Lambier?
it used to be Bill Lambier, but I met the new head coach, and he put me up in
Fantastic.
a nice rumor for us to go live. So I'm excited to go at it.
Well, very, very cool. Congratulations on the game. It was a lot of fun to watch from a neutral standpoint, so very exciting.
Yeah.
Anyways, let's jump into it. Hope everyone had a great Thanksgiving, as good as Brian had. Let's jump into the weekly preview. Not a ton of big names this week. None of the big Mega Seven for sure. Some interesting ones that are out there. If you're looking at some of the retail names, looking at some of the consumer sentiment names. Alta's a high flyer and one for me. But we're going to be looking at Snowflake. I think that's kind of a crucial one. Has some really interesting earnings history. So I'm going to be trading Snowflake. It's a really crucial internet security companies. In terms of economic releases, economic data this week. Next week's going to be the big jobs number. So we did not get that. The first Friday happens to be the first day of the month, so that's going to happen next week. We're going to get a lot of Fed speak, so that potentially could move the market. Other than that, we got the beige book and some housing data, which could also be interesting. But I want to look at this, and we talked about this every week. We're looking at what direction do people think the market's going to move over the next 6 months. For me, this has been a contrarian indicator. Again, just look at where we were at the start of November. Right here, we had 50% bearish, and that turned out to be a huge clue for contrarians. The market did fantastic after that. Now, last week, we had a second straight week of that really high bullish sentiment. I did say just kind of a continuation of the trend. I'm not seeing a lot here. Nothing's really pointing out. But this week, we got another tick up in the bullish sentiment. But very interestingly, we also had a tick down in the bearish sentiment. So that spread between the bull bear got very wide this week. This is starting to look a little bit like it could be good news for people looking for spots to short the market here. For me, I'm just kind of waiting and see, but I'm just watching this carefully. It's looking like it's getting a little wider. This is a little bit of an iffy spot for the bulls right here for me.
Yeah, Joe, it's been could be a lull, kind of sleepy week coming off of Thanksgiving, but obviously we have the Black Friday numbers, we have Cyber Monday going on. The retail segment will be really interesting to watch to see how that all shakes out, to see if the consumer is still hanging in there in this economy, because that's actually really been the key, is the fact that money and circulation has been plentiful, and the Fed's had to raise rates. We don't want to see that all tighten up and dry up. We do have a great show on hand here. As you see, we're going to talk a little bit about what volatility and the spike index has done relative to how interest rates have done throughout the show. We got a trade coming for you here on the triple Qs and the NASDAQ. I think things are setting up really nicely in there to bring to you. Joe also mentioned he's going to do a trade on snow and earnings, which comes out Wednesday after the close. And then, of course, every week we tweet out in the beginning of the day. If you want to reply to one of us, ask a question of the day, we'll answer it in the show. And then our most famous thing that we have going on here is, Stump STS, which is my trading acronym. This is where Joe tries to throw a fact out on me, and we give you just sort of a general tip on how we like to view the market and trade things. But let's jump back in it. Joe, you have some interesting stuff about the spike index, what volatility has done, how that relates to the interest rate and the yield curve. What do you make of things?
Yeah, so we know the holiday shortened week, the spike index closed very low post-COVID era. We were under 13. on the close on Friday. So that's a really low level for the spike index. But given the yield curve, given how flat it's been, given how long it's been in negative territory, what does that tell us about the future of volatility? Well, going back, we have two different kind of dynamics. We have, a flat yield curve and we have a steep yield curve, and then the shifting in between the two. You can kind of see where you get the flat yield curve kind of leads into this higher volatility regime, and then it shifts into the steep yield curve where it stays high and then it goes forward. And really, Brian calls this the circle of life. And it's really the circle of volatility in the Fed yield curve. So what typically happens, if you kind of go back through the last few cycles, you have a flat yield curve with high volatility, and then the yield curve steepens out with high volatility, and then it kind of turns around and flattens out. The market kind of recovers, the economy recovers, and then the whole thing starts anew. So remember, in 2007, the yield curve was flattening out. Volatility started to go on the rise, and it's just something that we've seen the last 3 decades just happen again and again. And it just really seems to me like this is where we are right now. We're right in a very long period of a flat yield curve. So we're very, very low on this side of the curve right now. When the yield curve steepens out, what's going to happen? Well, history suggests it's going to be a period of sustained elevated volatility before we see a recovery and back down.
Yeah. So, Joe, I mean, do you feel like obviously the yield curve is inverted right now, meaning that 10-year interest rates are lower than 2-year interest rates. So the government actually longer term gets to borrow at a cheaper rate, which just seems so silly to me. But in fact, that's the case right now. We now have the spikes index back down in the teens right now already. We've come off out of the 20s. Do you feel that what happens when the yield curve starts to go positive are we going to get another volatility event before, sort of like this puke out, wash people out a little bit to some degree, before the market can move higher and volatility permanently stay lower?
Yeah, so that seems to be the $1 million question everyone's looking an answer for. The question is, like, for me, is the Fed going to lower rates just out of the goodness of their hearts because they want to? Is there some sort of political pressure that they're going to do it? Or are they going to lower rates because the economy is slowing down? If the economy is slowing down, I think it's very likely this pattern is going to continue. We're going to see higher volatility than usual. But, we'll just have to wait and see. The Fed does have more tools now than they have had in the past. Since the Great Recession, we've seen the Fed be very creative. Just last year alone, just this year alone, with the regional banking crisis, the Fed pulled out some new tools. So it's certainly possible the Fed can thread the needle here, but history suggests when the Fed does lower rates, it's going to happen because we're seeing unemployment rising. It's because we're seeing economic activity contracting, and that always leads to things we're not really expecting, which leads to higher volatility. So if you're going to ask a question, what would I trade? What's my trade here on this cycle? What am I thinking of? Well, I'm actually looking at a QQQ trade here. Going to be looking at a long call position. So if I'm initiating a new trade, I'm just going to be buying a call. Realistically, for our clients, Brian, we're going to have a long call via a synthetic long call, meaning for people new to options trading, this is maybe options 201. If you own a stock, when I own a stock, I can buy a put position, and that new position, those two positions together, a long put plus a long stock, is essentially the same risk profile as a long call. So that's what I'd be looking at doing here. And I'd be really interested in this chart here too, because we're right at this crucial area. We brought this up too. So is it possible that we could trend higher and just go to new all-time highs? Absolutely. Can we just break out and keep on going? Absolutely. Am I looking at buying more right now, given where we are? Not so much. I don't necessarily need to add to my positions. And we talked about the low spike index, volatility, so cheap. I think having a protection here, using options to be long the market here is much preferred to me rather than just being straight long the market. And so that's what I'm doing. I'm looking at the March 389 call. That's for $18.50. I'll be risking 4.7% to the downside. Now, that might seem like a lot, but remember, just in the last month, we saw the NASDAQ, the QQQ rally 12%. So that's a reasonable risk reward profile for me. I'm putting out 4.7, risking to the downside. I know how much it can go to the downside if the worst case happens. So that's what I'd be looking at getting in here. I'm happy to pay out that premium, knowing, given where we are on the chart, given where we are with risk, given how low volatility is, I'm pleased with that trade.
Yeah, Joe, I like that. Sorry, I cut out there. Some technical difficulties cut me off, and but I got the gist of your trade here. When you're looking at sort of the risk, is there anything you would do here, though? Obviously, you're going further out, with a March call option, and it does look like to me the NASDAQ could be poised to break out to the upside, assuming this interest rate curve that you talked about earlier remains intact. Is there something you do to adjust to this trade? Because that's a lot of premium, obviously, for somebody to outlay. Personally, I know that this option is going to move more like a smaller delta, meaning less movement to the market relative to how the underlying QQQs move. I would almost buy 2 of these calls to get the same level of exposure. But again, then I'm outlaying more premium. Do you do something as the markets move to sort of offset this?
Yeah, so absolutely. If the market does move lower, of course, I will be losing less to the downside as opposed to owning QQQ outright. I might look to even add more because that's what I was saying. Looking at that chart, that's not a spot where I'd be looking to initiate a new position, looking to add on. So if it does come lower, it does go to narrow, I might be looking to double down on that call. Now, should we move higher? Yes, I will be. I am outlaying this premium, 4.7% premium. I will be looking, should we move higher, to sell some options against it, either selling a downside put, selling an upside call, maybe potentially both, just to collect some of that premium back, because 1850, as you mentioned, that is a high premium to pay out here. But I'm happy to do so given this risk profile.
Yeah, and I like how that trade sets up. I think volatility is pretty cheap. We saw the spikes index in the teens, so you're buying an option. If option premiums increase, if volatility rises, the call should hold on to some of that value. So I like buying this while volatility is low. And so that way, if we're wrong here and the Federal Reserve starts to cut interest rates, and that's the reason for the yield curve to sort of go positive again, because we're cutting short-term rates back below the 10-year. That's something that's going to create a lot of volatility. This option should hold some value in that case, and so sort of mitigate some of the losses. But hey, if the charts look good and we break out to the upside, you've got that call option there playing to the upside.
Yeah, and final point on this, back to that options trading kind of lesson here. For me, the 101 options play is to just buy a call directionally, right? Or buy a put directionally, or sell a call, sell a put directionally, because you think that's the way the market's going to go. The 201 play, kind of the next level for me, is looking at where the volatility level is and then the direction. So those two things in combination, because volatility is cheap, because I'm looking at adding on here, maybe a little protection, maybe a little less risk on the table. That's where I'm looking at this trade. Not so much only just direction, but also because of the volatility levels.
Nice. Well, let's get on to the next section here. We had obviously Snowflake earnings on Wednesday. That's a big one. Cybersecurity play here. The stock, basically we heard a lot in the news. CNBC wrote an article just recently that more and more firms are hiring for cybersecurity, or firms in general that are in the cybersecurity space, looking really to add jobs in that area, because that's more and more prevalent on our forefront here. And so as we get into that, we look in the election of 2024 and all the meddling that goes on in social media, but that obviously trickles down to certain cybersecurity issues out there. I think Snowflake plays really interesting here. Joe, you have a trade, earnings Wednesday. How are you playing this? How are you looking at this stock here? Obviously, we see that chart here. It's kind of stuck in a channel, isn't it?
Yeah, it's been so for the better part of a year and a half. Absolute COVID darling. Everyone was jumping in on it. It had a fantastic 2021, to say the least. It got hit with the NASDAQ in 2022, but it has not recovered like a lot of the other names. I think there's reasonable reason to believe, just for those reasons, just for what you were talking about, that there is some upside potential. That said, we're in the middle of this channel here. And I'm kind of both. I think it's playing to the upside, but two, I think it's going to escape this this center of the channel. It's going to either go to that downward extreme or that upward extreme. One potential way to play that would be to sell a call spread, selling the downside area, buying two calls, selling the upside area. They're just kind of benefiting on that volatility move. I just want to play it one way. I think it's going to the upside. I am looking at the December 172.5, 182.5 call spread. That's this morning it was $3.85 for me to put on. If it works out perfectly, we close above 182.5. The max gain is 615 for me there. So I like that risk reward. I like the directionality play. I think post earnings it will hold a little bit of value for me for the next week or so while I kind of wait and see. But I think if we go right to that upper end of that channel, I'll be really happy and I'll be able to take this off for a nice winner post earnings.
Yeah, so you must be playing this. You're selling basically a call at the upside of that channel, hoping that earnings, when we get this move, if it is to the upside, you're basically trying to sort of risk a little bit less here to make just as much, because I assume you're feeling that the stock hits that 182.5 level, probably finds some level of resistance there. We get a collapse in volatility, a collapse in option premium on that strike, and maybe a better way sort of to play, a smarter way to play a positive bullish view on the stock, right?
Yeah, and absolutely. And we're also looking at the volatility levels this morning. It looks like the implied volatility is a little bit light compared to how Snow historically has moved on earnings. Again, that goes back to my contrarian level thinking of options trading. When the options pricing in a cheap price, I want to buy it. When it's pricing in a high price, I want to sell it. That's just what I look at when I'm looking at these trades.
Yeah, and I think it's interesting that Joe's buying the option price that's right in the middle of the channel. That's typically what I'll do when you're kind of stuck in the middle. You want the stock or the underlying to move away from your long strike that you're owning, because that obviously will take away some of the decay issues. So we, obviously every time in the show we have questions of the day. You can write in, ask us. We'll answer it right here on the show. So it's a great little segment for you to interact directly with us. You can either chat, go through the chat live through YouTube as we present the show and ask us right then, or ask us a question beforehand. Jody, what do we got questions here for today?
Yeah, we got one question from the chat. Remember, feed us before the show, but we got one question today. What's your top trade for 2024?
Ooh, top trade 2024. Yeah, it's definitely on the horizon. And I like the MAMA play is my acronym. You got Microsoft, you got Apple, you got Meta, and you got Amazon. Or you can take out Apple maybe and put in Alphabet if you want to have a more AI swing to it. And those have really been the players. I think as long as we're sort of in this higher interest rate environment, we tend to see large cap names do better than small cap names. Maybe we can hit up that on another show. That's probably a whole nother segment to talk about. But the MAMA play I think is still in. I'm sticking with that into 2024, and I think AI is the word. It is the play. And if any of the semiconductors or whatever chips that are in that segment do well, I feel like some of these other areas of the marketplace that are at the forefront of the actual software being built around it will be the true players. And then you get a little consumer cloud play through Amazon as well.
I've got a couple more questions filtering in here. I'll piggyback on your answer there. There was another question based on the implied vol cycle for the S&P. What type of options trades would you be thinking about for next year? I think that's a great question. I think it'll look like 2007, like 1999. They will see a market higher, volatility higher. That's my base case. So my case is to buy calls. I'd be looking at, just like that QQQ trade that I put out there. I think vol higher, market higher is really my call for the market next year. And another question coming in here: do you suggest closing the Snow earnings trade before earnings. No, this is going to be on for the earnings, unless something fantastic happens and we're trading at 182. I'd be happy to do that. Or really, if we're above 175 and a half, I think I would probably close it. If it goes from a long vol trade to a short vol trade, definitely lock in the profits there, because I do think we're going to see a bigger than implied move on the earnings. So that would be when I would close it before the event.
Yeah, I like that. I mean, if a stock kind of runs in one direction before the earnings and you've gotten it right, don't be afraid to take that off. I like doing that because it's kind of, you can get the, buy the rumors, then sell the news. And there's such high expectations for this earnings event that it's very difficult for the stock to meet. And then usually you have some sort of profit taking that happens regardless if the earnings are good. So, Joe, it makes a lot of sense. You gave people a price target where you're looking to take this off. And so I would stick with that as well.
Fantastic. So let this be a lesson to you. Ask your questions. We'll answer them live on the show. Fantastic, everybody. Excellent. Thanks, everyone, for tuning in. So final segment of the day. This is my favorite segment, the Stump STS. STS, of course, the acronym of Brian Stutland from his trading days. So I gave you a question a couple weeks ago. What is the average decline after the first Fed cut? The question of the day is, how many trading days from the last Fed rate hike to the first cut is there? What's the average? And then what is the average gain or loss during that period? So how many trading days from the last Fed rate hike to the first cut are there on average? And what is the S&P 500 gain over that time?
I would say it probably takes about a half a year for things to sort of cycle through the system. Sometimes they actually say it could go on for 12 months to 18 months before whatever the Fed is doing or starts doing and what actually happens in terms of a volatility event. But I would say it's probably a tighter time frame by the time they've actually finished hiking. So I'm going to say 189 days.
You're in there. So 100 days is the average with
a little higher. I missed the margin of error. I was 2 for 2 on the last 2 weeks. I'm going to give myself a loss on that one. Still batting, over 500. So I guess that's okay. It's probably a little bit longer time frame. 100 days. Okay.
100 days there. Really, really interesting. The outlier I would look out here would be in 2006, 07. Look at that. It was close to a little over a year, more than 300 trading days. With a very sizable gain built in there. So that's certainly possible. And, of course, just like in 2000, we could see a loss and a little higher. So this is these are just averages. So nothing is guaranteed here. Past performance is not indicative of future results.
Yeah. And if I were to do something with that fact, basically, is I'm going to probably look to try and own some sort of put protection. Typically, if I have a longer term view or at least a negative view in this case, I might buy a put that's a little bit longer dated. I might actually buy a put spread. That way I don't really have enough premium to sort of outlay. And if I make this put spread tight enough in the strikes, it becomes more of a binary situation where either that put spread pays off for me or it doesn't, right? That's what I mean by binary. It either is going to happen or it's not going to happen. And in this case, I don't outlay a lot of cash and I just kind of make an odds bet on this decline, and I might do this a little bit farther dated out. So that's typically how I'll play it. Probably looking, obviously, the correction you see right there could be somewhat significant. I don't know if I actually answered how big a drop we would see, but this is one where I'm going to probably look 10 or 15% on the downside, longer dated, to add some put protection at when premium times are right and cheap, and keep the put spread strikes tight. So I play this as a binary outcome. It's either going to happen for me or it's not.
Yeah. So for me, the next 100 days looks, we've already had about 3 months or so. So we're getting pretty close to where they would be cutting. I think we can safely say it's going to be a little bit more than 100 days this time around, but might be about 130, 140 based on the market projection. So that seems about right. So for over that time period, I think the bias should be positive until the economic data changes. But when they do cut, history suggests things are negative for that time period while they're cutting.
Well, that just about wraps up the show. We thank the MIAX, the sponsor of the show here. We thank Tradier, obviously, for putting this on. Market Matters. We bring a lot to you here on this show, and we're really excited to bring it to you. Obviously, the spikes, the volatility indexes, that should be something to watch, obviously, over the coming weeks here. So great show, Joe. Any last words here before we hit the road?
No, keep it simple, stupid, and just enjoy everything, and keep your head on your shoulders. All right, take.